Let's start with a number that sounds impossible. In early 2025, BlackRock manages more money than the entire GDP of every nation on Earth, except two. But here's what makes this truly unusual. Most people have never heard of them. Ask a random person on the street to name the most powerful financial institution in the world, and they'll probably say JP Morgan, Goldman Sachs, or maybe the Federal Reserve. Almost nobody says BlackRock. Yet this company sits at the center of a web that connects your retirement savings to Chinese real estate, European government bonds to American tech stocks, pension funds in Norway to infrastructure projects in India. And it didn't get there through hostile takeovers or dramatic market moves. It happened quietly, methodically, almost invisibly. Here's the question we need to investigate. How does a company accumulate this much influence without most people noticing? And more importantly, what does it mean when financial power becomes this concentrated but also this diffuse? Because BlackRock doesn't own most of the money it manages. That money belongs to teachers, nurses, factory workers, retirees, ordinary people who probably don't even know BlackRock's name. This creates a strange paradox. The company is simultaneously everywhere and nowhere. It's the largest shareholder in your employer, but it doesn't control your employer. It influences corporate decisions across thousands of companies, but claims no direct power. It advises governments during crises, but holds no official position. What we're looking at isn't traditional corporate power. It's something newer, more complex, and potentially more consequential. It's the power that comes from being the infrastructure itself, from being the platform on which modern capitalism runs. And that's a very different kind of power than we're used to thinking about. So let's investigate how this happened, what mechanisms enabled it, and what it reveals about where global finance is actually heading. To understand BlackRock's rise, we need to talk about something that sounds boring but changed everything: index funds. In the 1970s, a guy named John Bogle had a radical idea. Instead of trying to beat the market by picking winning stocks, what if you just bought everything? Create a fund that owns a little bit of every company in an index, charge minimal fees, and let the overall market growth do the work. Wall Street laughed. Why would anyone pay a fund manager to not even try to beat the market? But Bogle was right, and they were wrong. Over decades, study after study showed that most active fund managers couldn't consistently beat simple index funds after accounting for their fees. The math was brutal and undeniable. By the early 2000s, trillions of dollars began flowing from active management into passive index funds and ETFs. BlackRock, through acquiring Barclays Global Investors in 2009, became the owner of iShares, the world's largest ETF platform. This wasn't just a good business move, it was a structural shift in how capital flowed through the global economy. Here's why this matters. When you buy an actively managed fund, the manager chooses which companies to own. Different managers make different choices. Power is dispersed. But when everyone buys index funds, they all own the same companies in the same proportions. Power concentrates automatically, algorithmically, without anyone consciously choosing concentration. BlackRock didn't create this system, but it positioned itself perfectly to benefit from it. As money flooded into passive investing, BlackRock's iShares ETFs captured a massive share. And with that came something unexpected: voting power. Because when you own stock through an ETF, the ETF provider votes those shares. Suddenly, BlackRock found itself voting in corporate elections across thousands of companies, representing millions of individual investors who had no idea this was happening. The index fund revolution democratized investing. Anyone could now diversify like a billionaire for almost no cost. But it also centralized corporate governance in ways nobody predicted or planned for. That's the paradox we're living with today. Now let's talk about Aladdin. And no, this isn't about Disney. Aladdin is BlackRock's risk management system, and it's arguably more important to understanding their power than the assets they manage. The name stands for Asset, Liability, Debt, and Derivative Investment Network. What it actually does is process and analyze financial risk across portfolios worth tens of trillions of dollars. Here's the critical part. Aladdin doesn't just work for BlackRock. It's licensed to over 200 institutions globally: pension funds, insurance companies, sovereign wealth funds, central banks, and even competing asset managers. These institutions pay BlackRock to use Aladdin to manage their own risk, and every time they do, Aladdin ingests their data. Think about what this means. BlackRock sees capital flows across a significant portion of the global financial system in real time, not through public reports or delayed disclosures, but through direct data feeds from institutions managing their portfolios on BlackRock's platform. It's like having weather satellites while everyone else is looking out the window. BlackRock maintains strict confidentiality agreements and data separation protocols. They can't use one client's specific data to trade for another client. But the aggregate pattern recognition, the ability to see macro trends forming before they hit public markets, that's a different category of advantage entirely. When BlackRock analyzes market risks or opportunities, It's not guessing based on economic theory or news reports. It's observing actual capital movement across a meaningful sample of global finance. This creates an information asymmetry that's perfectly legal but unprecedented in scale. An information asymmetry in finance translates directly to power. The genius of Aladdin is that it makes BlackRock indispensable to the very institutions that might otherwise be wary of its power. Banks need it. Pension funds depend on it. Even regulators occasionally consult it. BlackRock built infrastructure that the financial system now requires to function efficiently. That's not market dominance through competition. It's dominance through becoming essential infrastructure. Very different game, very different implications. March 2008, Bear Stearns collapses. The Federal Reserve orchestrates an emergency sale to JP Morgan to prevent systemic panic. But there's a problem. Nobody knows what Bear Stearns' assets are actually worth. They're filled with mortgage-backed securities so complex that even Bear Stearns' own risk managers can't properly value them. The Fed needs help fast. They call BlackRock. BlackRock sends a team to Bear Stearns' headquarters. They bring Aladdin. They start analyzing the portfolio. Mortgage by mortgage, security by security, derivative by derivative. They help the Fed understand what's salvageable and what's toxic. JP Morgan gets the clean assets. The Fed absorbs the worst stuff. BlackRock gets paid a consulting fee and, more importantly, gets credibility as the institution that can navigate financial chaos when banks can't. 6 months later, Lehman Brothers goes under. Then AIG. The entire global financial system teeters. The US Treasury and Federal Reserve create unprecedented bailout programs, and they keep calling BlackRock. The company becomes the de facto advisor on valuing and managing toxic assets across multiple failed institutions. Not because of political connections or lobbying, but because they had the technical capability nobody else had. This was BlackRock's inflection point. They entered the crisis as a large but not dominant asset manager. They exited as the firm governments trusted when traditional banks failed. Their reputational shift was worth more than any acquisition. It positioned BlackRock as the competent technocrat in a system full of gamblers who'd lost their credibility. But there's a deeper story here. Why was BlackRock so capable when banks weren't? Because BlackRock's business model never involved taking leveraged bets with its own capital. They managed other people's money for fees. They had no incentive to hide risks or pretend bad assets were good. Their interests actually aligned with transparency and accurate risk assessment. In a crisis built on opacity and deception, that clarity was invaluable. The crisis didn't just make BlackRock powerful. It revealed that their model was structurally sounder than the traditional banking model everyone had trusted. Fast forward to March 2020. COVID-19 shutdowns send markets into freefall. The S&P 500 drops 34% in weeks. Credit markets freeze. Corporate bonds become nearly impossible to trade. The Federal Reserve responds with the most aggressive intervention in its history, and does something it had never done before. It starts buying corporate bonds and corporate bond ETFs directly. This was radical. The Fed's traditional role is to manage monetary policy and act as lender of last resort to banks. Directly intervening in corporate debt markets crossed a line that had always been sacred. But desperate times required unprecedented measures. And once again, the Fed needed someone to actually execute this operation. They couldn't just start buying bonds randomly. They needed expertise, infrastructure, and speed. They called BlackRock. BlackRock was hired to manage multiple Fed facilities buying corporate debt and ETFs. The company essentially became the Fed's investment manager for these emergency programs. Think about the implications. A private company, which also manages trillions in private assets, including corporate bonds, was now also executing government purchases in those same markets. BlackRock implemented strict ethical walls and transparency protocols. They disclosed holdings publicly. They charged minimal fees, basically cost recovery. But the optics were undeniable. The line between private finance and public policy had become impossibly blurred. Critics called it the BlackRock-Fed merger. Defenders said it was pragmatic crisis management using available expertise. Here's what nobody disputes. It worked. Credit markets stabilized. Companies that would have defaulted got access to funding. The worst-case scenario was averted. But success does not resolve the underlying question. Should any private company have this much operational integration with central bank policy? What COVID revealed is that BlackRock isn't just large, it's systemically important. When crises hit, governments don't have alternatives. BlackRock has become financial infrastructure that public institutions depend on. That's not traditional market power. It's something more fundamental and potentially more problematic. Because infrastructure providers, by definition, are too important to fail. And we still haven't figured out how to regulate or constrain that kind of power. January 2020, Larry Fink publishes his annual letter to CEOs. These letters have become required reading for corporate executives worldwide. This year's letter makes waves. Fink declares that climate risk is investment risk, and BlackRock will begin screening portfolios for climate exposure. voting against management at companies with insufficient climate strategies, and potentially exiting investments in thermal coal, the reaction is immediate and polarized. Environmental advocates praise BlackRock for using its voting power to force corporate climate action. Conservative politicians accuse the company of imposing a political agenda through financial pressure. Both sides agree on one thing. When BlackRock takes a position, companies listen because they have to. But let's examine what actually happened afterward. Did BlackRock divest from fossil fuels entirely? No. Did they vote against every oil company board? No. What they did was more subtle and arguably more influential. They made climate risk a mandatory topic in corporate strategy discussions. CEOs who previously ignored environmental issues now had to address them in shareholder meetings because BlackRock would ask questions and vote accordingly. This raises a genuine governance dilemma with no easy answers. BlackRock argues they're protecting long-term returns. Climate change poses material financial risks, from stranded assets to regulatory changes to shifting consumer preferences. As fiduciaries, they're obligated to consider these risks. Ignoring climate would be dereliction of duty to the retirees whose money they manage. Critics argue this is corporate governance by proxy. BlackRock isn't democratically accountable. Their clients range from progressive California teachers to conservative Texas oil workers. Who decided BlackRock should prioritize climate over other concerns? Did millions of individual investors consent to this priority structure? The deeper issue is that when a single institution controls significant voting power across thousands of companies, any decision it makes becomes political, whether it wants to or not. Voting for climate action is political, but voting against it is also political. Remaining neutral is political. There's no escape from the fact that concentrated power inherently involves making choices that affect society beyond just financial returns. We haven't figured out how to govern this reality, and that's becoming increasingly problematic as stakes rise. August 2021. BlackRock receives approval to operate its first wholly owned mutual fund business in China. This is groundbreaking. For decades, China required foreign financial firms to partner with domestic companies in joint ventures, ensuring Chinese control and technology transfer. BlackRock got an exception, 100% ownership, operating independently in the world's second largest economy. Why did China grant this unprecedented access? Because they needed what BlackRock offered, credibility with global capital. China was opening its domestic bond and equity markets to foreign investment, trying to internationalize the yuan and attract trillions in external investment. Having BlackRock operate domestically signaled legitimacy and regulatory maturity to skeptical foreign investors. For BlackRock, China represented perhaps the greatest growth opportunity in its history. A rising middle class with high savings rates and limited investment options. A government encouraging financial market development. Potential trillions in domestic assets eventually seeking professional management. It was too big to ignore. But this expansion created immediate political problems in Washington. By 2022, tensions between the US and China had intensified dramatically. Politicians from both parties questioned whether the largest American asset manager should be deepening exposure to Chinese markets, potentially funding companies with military ties or human rights concerns. Hearings were held. Fink testified before Congress. BlackRock's position was consistent. They had fiduciary obligations to maximize risk-adjusted returns for clients. Excluding the world's second-largest economy would harm pensioners and retirees they served. They implemented screening for sanctioned entities and conducted human rights due diligence, but wholesale China exclusion would violate their duty. This revealed a fundamental tension in globalized finance. Capital wants to flow to returns regardless of borders. But geopolitics is increasingly fragmenting along national and ideological lines. Companies like BlackRock operate in the gap between economic logic and political reality. As that gap widens, their position becomes increasingly untenable. They can't simultaneously satisfy return maximization, political pressure from multiple governments, and ethical concerns from diverse stakeholders. Something has to give. We're watching in real time to see what breaks first. Let's get technical about something genuinely important: market concentration and its effects on competition. Academic economists have been studying what happens when the same investors own competing companies. The phenomenon has a name: common ownership. And the findings are troubling. Multiple studies examining U.S. airlines found that ticket prices were significantly higher on routes, where competing airlines shared large institutional investors like BlackRock, Vanguard, and State Street. The mechanism isn't conspiracy or collusion, it's aligned incentives. If you own both Delta and United, you're financially harmed when they compete aggressively on price. Your portfolio performs better when both maintain healthy margins rather than engaging in market share battles. The research extended to banking, pharmaceuticals, tech platforms, and other concentrated industries. The pattern held: greater common ownership correlated with less aggressive competition, higher prices, and sometimes lower innovation rates. None of this implies illegal activity. It's a structural effect emerging from the logic of diversified passive ownership. BlackRock and other large asset managers contest these findings. They argue they vote independently at each company, focus solely on that company's individual performance. They point out that passive funds don't choose to own competitors. They mechanically replicate market indices that include all major firms in each sector. But the economic logic is hard to dismiss. If the same entities control 20% of votes at all major competitors in an industry, does it matter whether that control is deliberate or algorithmic? The effect on competitive dynamics potentially remains the same. Some economists have proposed solutions, limiting common ownership in concentrated industries, requiring pass-through voting, where individual investors vote their own shares, or adjusting antitrust frameworks to account for ownership concentration. None of these solutions are simple. Pass-through voting with millions of small shareholders is logistically nightmarish. Limiting ownership creates market efficiency problems and potentially harms small investors who benefit from diversification. Antitrust action against passive index funds seems to punish success and efficiency. We're facing a problem where the optimal solution for individual investors, low-cost diversified passive investing, may create suboptimal outcomes for the overall economy through reduced competition. This is a genuine policy dilemma without obvious answers. And it's getting worse as passive investing grows. Late 2023, BlackRock files for a Bitcoin ETF with the SEC. This isn't particularly surprising. Multiple firms had filed similar applications over the years. What's surprising is that in January 2024, the SEC approves not just BlackRock's application, but multiple Bitcoin ETF applications simultaneously. BlackRock's iShares Bitcoin Trust launches and within months accumulates over 300,000 Bitcoin, worth tens of billions of dollars at current prices. This matters for several reasons. First, it legitimizes cryptocurrency exposure for institutional investors who couldn't previously access it due to regulatory uncertainty or custody concerns. BlackRock's imprimatur makes Bitcoin investable for pension funds, insurance companies, and wealth managers who would never buy crypto directly. Second, it gives BlackRock enormous influence over an asset class that was explicitly designed to operate outside traditional financial institutions. Bitcoin's philosophical foundation was decentralization and independence from institutional control. Now, the largest asset manager in history is accumulating significant holdings and bringing traditional finance infrastructure to cryptocurrency markets. Third, it positions BlackRock for whatever comes next in digital finance. Central bank digital currencies are being developed by dozens of nations. Tokenized securities and real-world assets on blockchain are emerging. Digital identity and programmable money are on the horizon. BlackRock is ensuring it has expertise, relationships, and positioning in these spaces before they fully mature. But there's a deeper strategic question. What happens when financial infrastructure becomes programmable? When money itself can execute conditional logic, enforce smart contracts, and operate autonomously through code? Traditional asset management involves human judgment, market analysis, and strategic decisions. What happens when assets can manage themselves according to preset rules? BlackRock is clearly betting it remains relevant by controlling the platforms, relationships, and regulatory licenses that connect traditional finance to digital finance. But whether that bet succeeds depends on how radically different the next financial system actually becomes. If blockchain truly disintermediates traditional gatekeepers, BlackRock's current advantages might not transfer. If it merely digitizes existing structures, BlackRock is positioned perfectly to dominate. The trajectory remains genuinely uncertain, which makes BlackRock's current moves fascinating to observe. So here's where we actually are. BlackRock manages over $11.5 trillion. It has unparalleled data visibility through Aladdin. It votes significant shares at thousands of major corporations. It advises governments during crises. It's expanding into China, cryptocurrencies, and emerging digital finance infrastructure. And it's doing all of this not through illegal activity or conspiracy, but through being exceptionally good at what it does within the system as currently designed. Is this dangerous? The honest answer is, we don't fully know yet, because we've never had a private financial institution with this combination of scale, data access, voting power, and governmental relationships operating in a globalized, digitized, increasingly interconnected financial system. We're in uncharted territory. The optimistic case is that BlackRock represents efficiency and expertise. They provide genuinely valuable services, low-cost investing for ordinary people, sophisticated risk management for institutions, crisis stabilization capability for governments. Their scale creates economies that benefit clients. Their data advantages improve market stability. Their influence pushes companies toward long-term thinking on issues like climate risk. This could be capitalism working as intended, rewarding the most efficient and capable institutions. The pessimistic case is that we've allowed too much power to concentrate in too few hands with insufficient democratic accountability or regulatory oversight. That common ownership reduces competition and harms consumers. That BlackRock's governmental relationships create moral hazard and blur public-private boundaries. That their data advantages could be used in ways we don't fully understand. That their China exposure creates national security risks. That we're building a system with a single point of failure. The realistic case is probably somewhere in between, and highly dependent on choices we make going forward. Do we require more transparency from large asset managers? Do we reform corporate governance to address concentrated voting power? Do we update antitrust frameworks for the passive investing era? Do we create regulatory categories for systemically important non-bank financial institutions? These aren't hypothetical questions for future consideration. They're decisions that governments and regulators need to make now, because the system is evolving faster than policy can adapt. BlackRock didn't take over the world's economy through a master plan, but through a combination of competence, strategic positioning, and being in the right place as structural forces transform finance. They've accumulated influence that we're still learning to measure and understand. The question is not whether BlackRock is evil or virtuous, it's whether our institutions and frameworks are adequate for governing the kind of power they represent. Right now, the answer seems to be no, and that's what should concern us most.